founded All-Star Charts about 5 years ago, really with the goal of just kind of, throwing ideas out there. At the time, I was doing a lot of research, a lot of homework, and I really didn't have a voice because I was still on the sell side. And that eventually led to me starting my own company and getting invites to the majority of media outlets out there. And I'm blessed and fortunate that we've had a ton of success since then. And about 3 months ago, we really ramped up the website allstarcharts.com, and we've gotten some incredible feedback. And I'm going to give you guys a sneak peek at that in a minute. But let's start rocking and rolling. So the agenda is very simple. We're going to go over some basics of technical analysis, the things that I use on a day-to-day basis, so that when we get into actual charts and the current market environment, you guys know what I'm talking about. So I'll get into real quick. It includes polarity, momentum, some Fibonacci analysis, and how we approach correlations. Then I'm going to show you guys how I approach the market from a top-down perspective. Start with a bird's eye view, and then really work our way down to the individual stock or futures level. We're going to go over today's market, some of the things that I'm seeing. I'm going to give you a sneak peek at allstarcharts.com from a member's perspective, so you can see what's going on in there. And finally, we're going to, at the end, I'm going to get into what I think right now is the best trade in the world. So this is from my attorneys. They love it when I show you guys this. Basically, everything that you guys see here, there aren't any sort of solicitations. These aren't recommendations to buy or sell. So I know you guys know this, but just want to reiterate that everything we discuss here is strictly for informational purposes, educational purposes, and before you do anything, make sure you consult with your advisor, make sure you're suitable to be doing some of the things that we're discussing. Again, I know you guys know this, but I just want to reiterate that. So quickly, technical analysis. A lot of misconceptions out there as far as, what it is. People talk about trend lines and support and resistance and moving averages and this and the other thing. At the end of the day, all technical analysis is the study of the behavior of the market and market participants. And while markets have certainly evolved over the last several hundred years and a lot of technological advances, let's keep in mind that it's irrelevant because supply and demand is driven by you and I. It's driven by fear and greed, and human emotions has not changed over the last several hundred years. So the principles that Charles Dow taught us in the 1880s, for example, can still be incorporated in today's market. We don't care why. Apple's up $30, or $20 in the last couple of months. Who cares why? There are more buyers than sellers. That's really all that matters. It doesn't matter if there's been an announcement or if there's some sort of fundamental change. We don't care about any of that stuff. We prefer to ask questions like what, when, how, for how long. Those are the questions that we want to try and answer. The question why is really irrelevant. Nobody in the history of the stock market has ever made 1 penny for knowing why there are more buyers than sellers. So while others like to focus on why, in the financial media and whatnot, why, we really don't care because it doesn't matter. All right, so let's start with the basics here. I mean, we talk about Dow Theory. The number one principle of Dow Theory, this goes back to the 1880s, guys, recognizing what is the primary trend. Is it an uptrend? Is it a downtrend? Are we seeing higher lows and higher highs? Are we seeing lower lows and lower highs? Or is there no trend and we're in a sideways range? The first thing we need to do when we approach a new asset is recognize what is the underlying trend. And as overly simplistic as this might sound, guys, you would be surprised as to how often people just ignore that and refuse to acknowledge what the underlying trend is. So that's priority number one. The second thing I want to talk about is polarity. Guys, this is supply and demand 101. We are looking at support and resistance. So in this case, we're looking at a blue line. Let's just, for argument's sake, call it Microsoft, the price of Microsoft. And every time we get back to this red level, let's call it $40, every time Microsoft gets down to $40, it bounces. And you can see the price bouncing off of $40 every time it gets down there. Eventually, the more times that a level is tested, the higher the likelihood that it's going to break, and then it breaks that support. So for a while now, this support level was holding, and every time it got there, the price bounced. Why? Because there were more buyers than sellers. There was more demand than supply, and the market was suggesting just that. Ultimately, when price breaks that support, the market is signaling to us that at that price, at $40, for whatever the reason, again, we don't care why, but for whatever the reason, anyone willing to buy at that $40 has already done so. And therefore, there is now an overwhelming amount of supply than demand at that $40 level. The market is suggesting that to us as we break that support. So whenever we retest that former support, it turns into resistance. Why? Because the market has already suggested to us that at that $40 level, there is now an overwhelming amount of supply than demand. There are now more sellers than buyers. So when we break on any retest, the market has already proven to us that there are more sellers than buyers, and that's why support turns into resistance. And it works both ways, guys. Let's call this Microsoft at 40 again. Every time we bump up to 40, Microsoft rolls over and sells off. Why? Because there are more sellers than buyers. There is an overwhelming amount of supply than demand. But eventually, the more times the level is tested, the higher the likelihood that it's going to break. Because eventually there comes a point where anybody willing to sell Microsoft at 40 will have already done so. And therefore there comes a time where now there's an overwhelming amount of demand and supply. There are now more buyers and sellers at 40. So once we break out and come back and retest that former resistance, it turns into support. Why? Because the market has already proven that at that $40 level, at a certain point, there was an overwhelming amount of supply than demand. There were more sellers than buyers. But that then changed. And at that price, there are more buyers than sellers. There's more demand than supply, and that's why former resistance turns into support. That's Polarity 101, and it's really where technical analysis begins, guys. Now, obviously, the market doesn't like to make it that easy on us, and oftentimes we have failed breakouts. So in this case, let's call it Microsoft at 40. Microsoft keeps bouncing off this level, rolls over, rolls over, rolls over, rolls over. Eventually, there comes a time where we break out to the upside. So the book, if you will, says to buy the breakout, right? You get new 52-week highs, new all-time highs in some cases, and then you get the headlines, right? XYZ hits new 52-week high because of fill in the blank. Whatever the 26-year-old journalist at the time thinks is the reason, whether it's there was a news event that morning that this particular journalist feels that it had some sort of contribution to this breakout, that'll be the headline. If there is no headline, they'll just go out of their way to make something up, perhaps, you know, China or non-farm payrolls or whatever the event of the day is, that will be quote-unquote the catalyst to send it to new 52-week highs. We obviously know that that is completely untrue and very just fabricated. So we not only are we not afraid of these failed breakouts, we want to anticipate them. And we'll get into a minute what are the certain ways that we can anticipate these, but let's just get into the supply and demand dynamics. Price breaks out. Anybody who's excited, all of the buyers buy the breakout, right? Anybody who is short against this level says, okay, I'm going to stay short against this level. If we break out above that level, I no longer want to be short the stock. And therefore, the short sellers get stopped out. So what happens on the breakout? You have all these new buys, the short sellers getting stopped and the new longs buying the stock. But a few days later, maybe a few hours later, the price starts to roll over back below that former resistance. So as it turns out, it was a failed breakout. So anybody who bought the breakout is now wrong. Any short seller that got stopped out is now no longer in the trade. So as this starts to roll over, anybody long that's wrong has to sell it in order to unwind their position. Anybody who was short that got stopped out has to re-short in order to be in the position. And that's where the momentum players, that's us, step in and try to take advantage of it. And that's why you, from a failed move, you get a fast move in the opposite direction. What's the trade? When you start to recognize price getting back below that former resistance, you short it right there. If you get back above there, all bets are off. So from a risk management standpoint, it's very, very clean. And that's why the risk reward from a failed breakout is one of the most opportunistic scenarios for any investor or trader. And this goes for all time horizons. This could be a daily time frame. This could be a monthly chart. So these principles are for both short-term and long-term investors. And it works both ways. In this case, we're looking at support breaking down after testing that level a million times. The short sellers get excited. This was very similar to gold miners in January. You have a breakdown to new 52-week lows. The 27-year-old journalist makes up a reason for that. She has no idea, or he has no idea what it is, but blatantly makes up a reason for a new 52-week low, and then all the short sellers get excited. They sell short on the new lows. Anybody who is long, holding their longs only above that level, gets stopped out and is now no longer in the trade. So what happens? A few hours later, a few days later, price starts getting back above that former support. Anybody who sold short is now wrong. They need to buy it back to unwind that trade. Anybody who was long against that level that got stopped out needs to buy it back to be back in the trade. That's where the momentum players come in. That's us. The buy is right there, right back above that former support level. If we start to break back below it, all bets are off. So the risk is very well defined. But because of the unwind of all of the losers, all of the losing trades down here that listen to those headlines for that matter, that's where you get the squeeze. So from a risk-reward standpoint, it's very much skewed in favor of the bulls. So I wanted to show you this, guys, because it really presents some of the best risk-reward opportunities of any trade setup out there. Again, regardless of time frame. This could be on an intraday basis for day traders. It could be on a monthly time frame, looking out years for long-term investors. So the market is fractal. It works both ways. By the way, as we go along, you're seeing all of these slides. Down here on the bottom right, you can see allstarcharts.com/free. If you're interested in seeing these things in real time, if you sign up for a free membership, you will get a free chart of the week along with some other bonus content as well, some educational stuff. So if you're seeing the allstarcharts.com/free down below on all the slides, feel free to go ahead and sign up free of charge. So I want to get into this real quick. We're looking at this failed breakdown turning into a fast move in the opposite direction. Here's a real life example. Here we're looking at U.S. Treasury bonds at the end of 2013, putting in that failed breakdown, and sure enough, this is where economists, 64 out of 64 Wall Street economists polled, said that bonds were going down and interest rates were going up. Every single Wall Street economist unanimously said to sell bonds right here. As it turned out, the following year, 2014, was actually one of the greatest years in the history of the U.S. Treasury bond market, which is why when Wall Street economists as a consensus all agree on something, we're better off, much better, taking the other side. That's why there are economists that are not allowed to actually trade. They just think philosophically, theoretically, not realistically. So everybody's seen this head and shoulders pattern, right? It's actually a very rare pattern, but because it's such a silly name, it's easy recognizable and easy to catch. But the reality of the matter is actually very rare. So in this case, you know, we have a higher high followed by another higher high followed by a lower high, right? So this is quote unquote what the book says is the head and shoulders top. After you break down from below the neckline, which is all of the support, sometimes you get the kickback and then roll over, right? This is your traditional quote-unquote head and shoulders pattern. But in reality, markets by definition trend in nature. So by looking for reversal patterns, you're essentially defeating the entire purpose of what we're doing here in the first place. So what happens more often than not is the principles that we just discussed before. Eventually, that neckline is broken. You know, the headlines are obviously, you know, whatever the journalist decides that is the catalyst for this new low and confirmation, quote-unquote confirmation of the head and shoulders top. But more often than not, a few days later, a few hours later, you know, prices start to creep back above that neckline and you get the squeeze. All of the short sellers are wrong. They need to cover by buying it back. Anybody who is long that got stopped out needs to buy it back in order to be back in the trade. That brings in the momentum players. That's us, and you get the monster squeeze. The buy is very simple. You buy it when you get back above the neckline. If you fall back below it, all bets are off. So from a risk-reward standpoint, it doesn't get better than this. Here's a real-life example. Here's the S&P 500 in 2010 in the summer. Here's your left shoulder, your head, your right shoulder. Prices broke down. You know, not to pick on anybody, but I remember specifically Sue Herrera on CNBC. I guess at that day she decided that she was going to be a technician. She suggested that this is the head and shoulders top. This is in June, getting into July of 2010. She said that that's it, head and shoulders top, market's going lower, and then we know what happened after that, one of the most historic rallies in American history. It just goes to show you that these head and shoulders tops are very rare. They're usually whipsaws, and they can present some incredible buying opportunities, particularly when people, you know, journalists on TV or whatnot start pretending they are somebody they are not. So let's talk about moving averages quickly. You know, when I use a moving average, it's a type of smoothing mechanism. I like to use a 200-period simple moving average. So when I say period, if I'm looking at a daily chart, I'm looking at a 200-day moving average. If I'm looking at a weekly chart, I'm looking at a 200-week moving average. So I don't use it for support and resistance purposes. At the end of the day, this is an invisible line. So there were never any shares that changed hands at these particular moving averages. What I really use it for is as a supplement to price to help with trend recognition. You know, I don't care if price is above or below. the moving average. I want to know what direction that moving average is heading in. Is price above an upward sloping 200-day moving average? Then it's probably not in a downtrend. Is price trading below a downward sloping 200-day moving average? It's probably not in an uptrend. So that's how we look at it. And something we want to stay away from is when price is near a flat 200-period moving average, because that really just creates headaches. You know, when you see price near a flat 200-day moving average or a flat 200-week moving average, the market is suggesting to us that there is no trend. Breakouts tend to fail, breakdowns tend to fail, and the reversions to the mean are very constant. So this is not something, whenever you see price near a flat 200-period moving average, do yourself a favor, stay away. Now let's talk about momentum real quick. I use a relative strength index, RSI, not to be confused with relative strength. Relative strength is when you're comparing one asset to another, usually the S&P 500. So it's just called the relative strength index. But at the end of the day, it's a measure of momentum. And when I say 14 period, if I'm looking at a daily chart, it's a 14-day RSI. If I'm looking at a weekly chart, it's a 14-week RSI. At the end of the day, it's an oscillator, which means that it moves between 0 and 100. So whenever you hear that word oscillator, that's really all of that means. I appreciate you coming in here, Confidence Verasi. Is there a live trade room? No. I don't think that there's any reason to be looking at the market 24 hours a day in a chat room. I never found any value in that, so I would never preach that. I think markets should be looked at upon the close. Closing prices are the most important price. So to have a live trade room during the day, I think defeats the entire purpose of what we're doing. I hope that answers your question. So the other way that I use momentum is by just looking at a range. I use momentum two different ways. The first way, just by looking at a range. Traditionally, 30 is oversold, 70 is overbought. When markets are in an uptrend, in a strong uptrend, on corrections, right? Because nothing goes straight up. So even if you're making higher highs and higher lows, the market still has corrections. But on those corrections, momentum never hits oversold conditions, right? That's characteristic of a strong bull market, a strong uptrend. In the case of a downtrend, of a strong downtrend, markets are going down. They're making lower lows, lower highs. And when markets rally and have corrective rallies to the upside within a downtrend, they fail to get overbought. You never see downtrends, strong downtrends, getting above 70, getting above those overbought conditions. However, on any sell-offs within downtrends, you're going to hit oversold conditions below 30, right? That's just the way it trades. And then in the strongest bull markets and the strongest uptrends, momentum won't even get below 50. And in the strongest downtrends and the strongest bear markets, momentum won't get above 50. So just right off the bat, a very quick and dirty, easy way to use momentum, see what kind of range it's in to confirm your underlying bias. And then the second way that we look at, Nick wants to know if I sometimes use long-term dailies instead of weeklies when I decide to use, if I'm looking out, 6, 7 plus years, I'm looking at a weekly chart. If I'm looking a few years, I'll use a daily. Hope that answers your question, Nick. And Aaron wants to know if I focus more on failed breakouts versus breakouts in the expected direction of the pattern. It depends on the weight of the evidence, right, which we'll get into in a minute. So it depends on the market environment. If we're in a strong downtrend and the majority of stocks are going down, there's a high likelihood that breakout is going to fail. Same thing if we're in a strong uptrend and a market breaks down, there's a high likelihood that breakdown is going to fail. So it really just depends on the overall market environment, and we'll get into in a second how we take the weight of the evidence approach. Getting back to momentum, the way I want you to approach the second way that we use momentum is think about a tennis ball. Throw a tennis ball up in the air. Before the tennis ball hits its peak, right, that momentum is going to start to slow down. And if we're paying attention, we can recognize that slowdown of momentum before the price peaks. And, it works the exact same way in the markets. You can see momentum slowing down before price peaks. In this case, we're looking at a chart. Up top is price. Down at the bottom is a relative strength index, momentum, RSI. And when you're seeing higher highs in price, you're also seeing higher highs in momentum. But there comes a point where prices put in higher highs, but momentum puts in a lower high. That's what we call a bearish divergence, and that is a signal that the trend is changing. Doesn't necessarily mean that the trend is going to reverse, but definitely changing. In this case, the trend went from an uptrend to a sideways trend and then ultimately rolled over and started making new lows. Also notice how momentum started reaching oversold conditions, suggesting and confirming that this is a new downtrend. In this case, it's the opposite. We have a solid downtrend. Prices are making lower lows and lower highs. And with every lower low, momentum is also putting in lower lows. Ultimately, there comes a time, this is actually a chart of silver in the summer of 2012. Momentum put in a lower low into July, prices put in a lower low into July, and momentum put in a higher low, suggesting that there was a bullish divergence taking place. So sure enough, prices went from a downtrend to a sideways trend, and then ultimately broke out in the fall and went on to make new highs. Monster move. And momentum signaled that something was changing. So correlation, right? When we talk about diversification, people talk about, oh, JC, I own financials, or I own tech, I got energy, so I'm diversified. No, really you're not, because you just own a bunch of U.S. stocks. In this case, we're looking at a correlation coefficient matrix where on the x-axis we have all of the major U.S. sectors, and on the y-axis we have all of the major U.S. sectors. And each cell represents the correlation coefficient between the two. The more green it is, the more they move together. In other words, the higher their positive correlation. Notice how there is a ton of green here. You see a little bit of brown in the utilities because traditionally they have lower correlation because of their high dividend paying nature. But for the most part, there's a ton of green here, right? Notice how there's a lot less green here. A lot fewer green cells, a lot more orange and brown. Why? Because you got 20 countries on the y-axis, 20 countries on the x-axis. And each cell represents the correlation coefficient between the two. And obviously, there's a lot less green here. And there's a very, very good reason for that. It's because there's a lot less correlation between countries than there are in the S&P 500. So is this diversified or is this diversified? It's an obvious answer. It's rhetorical. But the reason that I show this is because if you really want to get diversified, if you really want a non-correlated portfolio, you got to look outside the U.S. borders. So we treat everything the same. Whether we're trading shares of Apple or Tesla or the euro or crude oil or Microsoft or Greece or the regional bank index, it's all the same thing. It doesn't matter. Great, Apple makes nice cell phones and it's the biggest company in the world, but it should not be treated any differently than Tesla or wheat futures for that matter. It's all math and letters, folks. There's no emotions that need to get involved. So I'm going to get into Fibonacci, and for you guys that are familiar with Fibonacci, I'm not going to get into, if you guys want me to send you more information, email me, go to allstarcharts.com, use the contact, and I will email you a ton of stuff that I've written on the subject. It's pretty incredible stuff. But the bottom line is, I want you to recognize that the major number here that we want to look at is 1.618 and 61.8. Those are the key Fibonacci numbers that come into play in the market every single day that we can use to help us make money. So when prices correct an underlying trend, in this case we're looking at a downtrend, and it's an upwards rally, right? It's a counter trend rally. Prices often, if it is indeed a downtrend, prices are going to stop rallying right around 61.8% of the prior correction. If we continue to rip right through that, then it is not a downtrend anymore. In all likelihood, the trend has changed. So that level is really, really important. How the market reacts to that level really tells us what the direction of the underlying trend for sure. And then a lot of times, once we eventually exceed that, right, so we have a downtrend, we have broken out back above that prior high, the market tends to stop rallying at 161.8% of that previous decline, right? The market recognizes these levels. A lot of people, for whatever reason, choose to ignore Fibonacci analysis. I have no idea why. The market obviously recognizes it. So I actually think it's irresponsible if you're an investor to ignore these Fibonacci levels. I think it's very irresponsible. Here's a good example. Here's the S&P 500, the top in 2007. You got the bottom in 2009. And where did the market stop rallying? It stopped rallying last May at exactly the 161.8% extension of that entire decline. And you guys, I know there's people on this webinar that have been following me for a long time and know that coming into last year, I was saying, I'm like, guys, we really need to be careful because we're running right into this level. So this isn't a hindsight, it's 2020 sort of nonsense. I've been talking about this chart for about 18 months now, and the market obviously recognizes this level. So again, I think it would be irresponsible of us not to. Meanwhile, while that's happening, the NASDAQ Composite is running into the 2000 highs. From March of 2000, it took 15 years for the NASDAQ Composite to get back to those highs. You think we're going to rip right through that without even just acknowledging that overhead supply? Again, I think it would be irresponsible to think that. So here's the S&P 500. I ultimately think we drop under 1,600. That's the former high. So structurally, I'm very bearish. But short term, we've been really bullish. Here we are on February 23rd. This was a little bit old, but the trade was essentially, listen, if we got back above the August and September lows, we needed to be long with a target over 2,000. You had a bullish momentum divergence at the February lows, and everything said buy the S&P as long as we're above the August and September lows. And here we are. A week ago, we ran into that target above 2,000. There was no reason to be involved in that. Over the last week, our targets are hit. Time to get out. And sure enough, we've just been rolling over and just struggling with this level. This is very normal. So while short-term I'm bearish, while long-term I'm bearish, short-term I'm still very neutral. Here we are with price near a flat 200-day moving average. So no reason to be long or short. I think there are better places to be. Another reason why we wanted to get very bullish in February was because the internals were improving. You know, when prices made new lows in February in the S&P 500, there were half the amount of new lows in the New York Stock Exchange than we saw in January. Notice how on those January lows, we hit almost 1,400 new lows on the New York Stock Exchange. And on the February lows, while the index itself made new lows, the components had already bottomed out in January. And by the time S&Ps made new lows in February, we only saw half the amount of new 52-week lows on the New York Stock Exchange, suggesting the internals were already improving. And they continue to improve today as we see more and more new 52-week highs. So the internals have definitely improved short-term. Although we're still neutral, I've seen some constructive action. Here's Russell 2000. The trade was buy it if we get back above those January lows. Sure enough, we did. Bullish momentum divergence. And we want to sell it at that former support from August and September. Sure enough, this was a few weeks ago. We had hit that target, and there's been no reason to be involved ever since we got back to that former support. And sure enough, so this was March 4th. This is today. Notice how we hit that target, and we've done nothing ever since. We've just been muddling around. Why? Because that former support turned into resistance. So right now, there's no reason to be long or short Russell 2000. A chart that I've liked tremendously is junk bonds versus treasury bonds. You know, some people tell me that there's a crisis in junk bonds. I see price getting down to the 2008 lows, and every reason in the world to be long of junk and short of U.S. Treasury bonds. Look at that bullish momentum divergence on the retest of the 08 lows. And then this is a price-only chart. Here we're looking at a dividend-adjusted chart because we're talking about interest rate-sensitive securities here. And if you want to look at it dividend-adjusted, it tells us the same thing. We're down to the 61.8% Fibonacci retracement of the entire 2008-2011 rally. It was also support in 2011-2012. Again, bullish momentum divergence. Everything said, buy junk, short treasuries. And sure enough, this has worked tremendously. This trade is up 10% over the last couple of months, which in the treasury bond world is a lot. And I think it continues to go higher. We want to be buying junk and shorting treasuries. Here we're looking at Apple, getting back to the Fibonacci extension. You know, we're looking at, look at that bearish momentum divergence in 2012. This isn't a hindsight thing that we're looking at. I was actually writing about it in September 2012. Is Apple stock about to crash? Sure enough, it did. But moving forward, you know, if you take the 161% extension of that entire decline from 2012 to 2013, it takes you to about $130. So once we got there a year ago, there's been no reason to be long Apple ever since, and every reason to be short, which you guys that have been following me know that I've been pounding the table to be short Apple over the last year, and our targets were hit last month. So there's been no reason to be short Apple, and every reason to be long Apple for a trade back up towards 108. This is the chart on February 23rd. We had already broken above the downtrend line from the highs in the previous months. Here we are on March 4th, already rallying towards our target. And here we are a week ago, rallying towards our target. And here we are today. We already hit our target and now essentially rolling over. So no longer any reason to be long Apple, but I think it's important to show you the transition, the way it works, the way you go from super bearish to neutral to bullish, and now neutral again once our target has been hit. Here's the S&P 500 relative to emerging markets. In other words, where would you rather be, U.S. stocks or emerging markets? Here we're looking at an uptrend channel going back 5 years, running into the upper end of that uptrend channel, and we've been suggesting for 2 months now, buy emerging markets, short S&P 500. Here the chart is on March 4th, continuing to go lower, nice bearish momentum divergence at those highs. And this is what it looks like today. This is upside down. So this is the actual trade in long emerging markets, short S&P 500. Nice rally over the last couple of months. I think it continues. We only want to continue to be long as we're above the December highs. Part of the process, and I could send you this spreadsheet, but I conduct experiments. Part of the reason why we've been so bullish in emerging markets is because of all of the relative strength that we're seeing. Bullish momentum divergences on the daily time frames, on the weekly time frames, relative to S&P. Emerging markets bottomed in January while developed markets continued to make new lows into February. And I conducted an experiment and, notice how the majority of the bullish divergences on multiple time frames and the bottoms in January came out of the emerging markets. You guys can email me and I'm happy to send you this list, but this was an experiment conducted almost 2 months ago and really suggested buy EM, get out of S&Ps. So the trade January 26th was buy South Africa. There was no doubt about it. We had hit our 161.8 extension of the 2013-2014 rally. Our targets were hit. We wanted to cover all shorts near 41 and get long due to that bullish momentum divergence on both weekly and daily timeframes. Here we are about a month ago already rallying. Our target was 51. This is March 4th, continuing to rally, now breaking downtrend lines. And our target was hit over the last week. So former support is now turning into resistance, and we've rolled over. Now there's no reason to be in South Africa any longer, but this was a 30% move in a very short period of time. I like China. Here we are running into the 2011 lows. We have bullish momentum divergence. Here's a daily time frame, bullish momentum divergence, failed breakdown. I think China goes a lot higher. Here's the chart a couple of weeks ago, already making new highs. Here's what the chart looked a week ago, continuing to make new highs. I think we head up towards 36. Here's the weekly time frame. Look at the failed breakdown below the 2012-2013 lows, bullish momentum divergence. I think we mean revert and head up towards 38. A big catalyst I think that can do that is the Shanghai Composite. Look at the August lows in the Shanghai Composite. Now we are back above those August lows. I think the squeeze is just getting started. Here's crude oil. We broke. This is a chart a month ago. We were below the 2008-2009 lows. Bullish momentum divergence. The trade is we only want to be long if we're above the 2008 lows. Here's a chart a month ago showing that a daily chart showing the breakout above the downtrend line from last year's highs. Already breaking out. This is a chart 2 weeks ago showing the breakout above that downtrend and now back above those 2008-2009 lows. And then obviously we continue to break out. I think we head up towards 50. That's where we want to be taking profits and only be long if we're above the 2008-2009 lows. I promise you guys natural gas. I think it's the same trade. Here we are. Here's the 2012 lows. That's about $1.90. I only want to be long if we're above $1.90. I think we can head up towards $3. But again, $1.90 is the level. If we're below that, there's no reason to be long. If we can somehow manage to get back above that, it would confirm a failed breakdown and we can get a monster squeeze going in natural gas. I want to give you guys a sneak peek as to what's going on in allstarcharts.com. We have a chart book. Here's just a snapshot. This isn't all of them, but just a quick idea as to what you guys can see. All the S&P sectors from energy to financials, gold miners, et cetera, et cetera. There's over 35 S&P sectors. And notice how everything's on both a daily and a weekly time frame. Same thing with global markets. We're looking at China, India, Russia, Vietnam. Everything in Europe, everything in the Pacific, everything in Latin America. There's about 85 global market charts. We look at all 30 Dow components. We talk about these indexes like they're one thing, but at the end of the day, they're a basket of stocks. And by looking at the Dow 30 components, it's only 30 stocks. So if more of the 30 look like they're going higher than lower, in all likelihood, the U.S. stock market is probably not going lower. And on the contrary, if there are a majority of stocks in Dow 30 looking like they're going lower rather than higher, in all likelihood, the U.S. stock market is not going to rally. So looking at the Dow 30 is a very, very important part of my process. Notice on the right all of the U.S. averages and interest rates. They're not all listed here. It's not just S&Ps and Dow Industrials, but we're looking at the Russell 2000, the NASDAQ 100, the Mid-Cap 400, etc. All of the commodities and the currencies that we look at are from energy, like crude oil and natural gas, to metals like gold, silver, copper, palladium, platinum, to all of the agricultural commodities like corn and cotton, which right now, if you guys have been following, is one of my favorite places to be in the world right now in these soft agricultural commodities. Look at cocoa, coffee, sugar. All of these are broken down on both daily and weekly time frames. We also look at all the currency crosses, everything from euro to yen to Australian dollar, Canadian dollar, British pounds, and a lot of the crosses between them, like, for example, euro yen or pound yen. So we use these for informational purposes and also for trading ideas. Again, daily and weekly time frames. And finally, we have the intermarket analysis, which are really looking at that. This really helps with money flow, guys. I showed you guys a couple of intermarket charts before, looking at junk versus treasuries, looking at emerging markets versus S&Ps. These intermarket relationships are very important, and again, are broken down and updated pretty much every 7 to 10 days. We have a premium newsletter that goes out once a week. Really breaks down U.S. stock markets, global markets, what's happening in commodities, what's happening in currencies, some of the intermarket relationships that we're looking at, and always trading ideas, both from the index level to the ETF level to the individual stock level. And that premium newsletter goes out usually around a Tuesday of every week. This is what it looks like. It's more of a beach read. You want to sit down, have a cup of coffee, maybe pour yourself a glass of wine, and just give it a read. And then you can go on and use the chart book as a reference point. After all of that, we just added, because there was so much research being put out, we got some feedback from members that were suggesting to us that it was a little bit overwhelming because there was so much going on. So this week, we actually added the trade ideas page. You go to allstarcharts.com/trades, you will be able to see every single trade idea. Here's just a snapshot of February 10th. We were bullish S&Ps, bullish Dow, bullish South Africa, neutral treasury bonds, or bullish Yahoo, etc., Apple, bearish US dollars, bullish crude oil, bullish copper. But you can click on any of these and it will take you exactly to the commentary discussing exactly where to manage risk, where to put stops, where the targets are. And that list can be accessible for all members at all times. And I think it's a great new feature that our members were asking for. We listened, and it launched this week. And after all of that, after the chart book, the weekly letters, we have a monthly conference call that our members tell us that's their favorite part of the entire membership process, is really the monthly conference calls. I go in there quick and dirty, talk about some of the important topics, concepts, and charts that I think that we need to get to. And then I try to leave as much time available in the monthly conference calls to really talk about whatever you guys want to talk about. We're in this together. I mean, this is a team. So I try to get my points across as fast as possible, and then open it up. We look at charts, and then whatever it is that you guys want to talk about, we'll go ahead and do that. And I think that's the reason why our members tell us that it's one of their favorite aspects. So what we're going to do today is I'm going to give you guys, because you guys invited me here, and I really appreciate the invite, we're going to give you guys a huge discount to All-Star Charts membership. The quarterly membership is normally $397. What we're going to do today is give you, for $297, we're going to knock off $100 off that on a quarterly basis. You get the chart book, the weekly newsletter, the trade ideas page, the monthly conference call, a members-only forum, direct access to myself, and of course a 30-day risk-free trial. So if you're not happy with it, by all means, we'll send you your money back. It's a 30-day risk-free trial. But what we're going to do, if you sign up today, we're actually going to give you an introductory price of $77 for the first quarter. That's over an 80% discount to regular prices. So if you sign up today, allstarcharts.com/intro77, allstarcharts.com/intro77, you'll get the first quarter of All-Star Charts for $77. Guys, this offer expires on the 27th. It expires very soon. So my advice to you, jump on this, take advantage. $77, guys. $77 for the first quarter, and it's a 30-day risk-free trial. So even if you don't like it, for $77, Trader wants to know if you get a set of steak knives. No, but that's funny. But yeah, like I said, $77 for the first quarter, 80% discount to regular prices, and again, it's a 30-day risk-free trial. So this is for new members only. New members only can take advantage of this. This introductory price is for new members only, and it expires in just a couple of days. So take advantage of that. So I promised you guys I would show you guys what my favorite trade is right now. I want to walk you through a little bit of the process. Here, this was a tweet that I put out on January 21st saying, anybody think this is a chance to be a failed breakdown in gold miners? This was in January, and I heard crickets. Nobody, everybody hated gold miners in January. And a week later, I said, there's your move above gold miners, above 13. That was the trade. We only wanted to own gold miners if we're above $13 because it would confirm a bullish momentum divergence and a failed breakdown. Sure enough, we've just witnessed one of the most epic rallies. A month later, gold miners just literally exploded, saw close to a 50% rally in gold miners in just a month. So we nailed it, right? So, okay, JC, you guys are sitting there. All right, JC, you're patting yourself on the back. Great. How does this help us? Well, I'll tell you how it helps us. I think that although short term that was a monster move and we couldn't be happier and we totally nailed it, I think that the implications of that. By the way, I see Nick just signed up for the membership. Nick, welcome aboard. I hope you enjoy it. Good thing you took advantage of that. Well done. Happy to have you. Look forward to seeing you on the conference call in a couple of weeks. I think you'll enjoy it. So I'm getting back to the best trade in the world right now. I think you own gold miners as long as you're above the '08 lows. If you're above the '08 lows, you want to jump on this and be all over this. I think we see $33, which depending on where you get in could potentially be a double. So that's how I look at it, and I just want to reiterate the process. This was a failed breakdown below the lows from the past 6 months. Okay, we wanted to own it for a tactical trade above 13. That worked tremendously. Now we take our profits, we get out of the way, and we take a step back and we look bigger picture. So what are the implications of this going forward? This monster move we saw over the last 2 months. What happens to the trend bigger picture? Personally, I think the trend has changed. I think that we are now in an uptrend in gold miners. It confirmed a monster 6-month failed breakdown, a bullish momentum divergence. We broke above the downtrend line from the 2013 highs, and I think off to the races we go. The risk management-wise, we only want to be long if we're above the '08 lows, and we want to be taking profits near 33, which represents that gap fill from early 2013, and also represents the 38.2% Fibonacci retracement of the entire 2011 to 2016 decline. And Jason and Pauline also just signed up. Welcome aboard. Thank you. I really appreciate you guys being here. Make sure that when you're on the conference call in a couple of weeks, make sure that you reiterate to me that you guys signed up using this trial. I'll give you guys a shout out. Our members love hearing from new members, so I really appreciate you guys being in. Welcome aboard. And again, here's the slide. For you guys that have not signed up, allstarcharts.com/intro77. Not only are we knocking off $100 off the quarterly membership, if you sign up today, guys, we're giving you an introductory price of $77 for the first quarter. That's over an 80% discount, and it's Intro 77. Intro 77. The offer expires on March 27th. allstarcharts.com/intro77. And again, 30-day risk-free trial. If you don't like it, you get your $77 back. So, but we're confident that you'll love it and you'll be with us for a long, long, long time. And I look forward to communicating with you guys both on the monthly conference calls as well as on the message center. Our members use that message center. They ask me for advice on specific trades. They ask me questions, and I fully advise all of you not only to sign up, but take full advantage of all of the resources that you have on the website. So thank you for having me, guys. I really appreciate the invite. Hopefully we can do this again, but thank you again.